First of all, the ground rules there aren't any. If you disagree with what I'm saying, or if you want to jump in and interject some comments, go ahead. I'll manage the time, and if I think we're going too long, I'll try to moderate it. I'm used to that at Stanford with our MBA students, so I think I can probably, maybe not, but I'll try to keep you all under control. And then at the end, I hope we have lots of time for Q&A, because obviously the reason I'm here is not to say what I already know to be my own opinion, but to find out what you think. So please don't hold back. There's a number of issues, policy issues facing the credit derivatives markets. I want to briefly go through what I think the main issues are in front of us today and give you some of my views and back them up as much as I can with the facts on the ground. The main issues, as I see them, are how to do clearing, what to do about transparency, both from the viewpoint of price and exposures. What about treating credit derivatives as insurance, since effectively they are, in terms of economics, insurance. That is, treating them as insurance for regulatory purposes. I have some views on that. And what about the issue of moving the credit derivatives markets onto exchanges, or some parts of them? Now, these are all very controversial issues, except maybe clearing. I would bet that almost everybody in the room, including myself, thinks that clearing, which I'll explain in a minute for those of you that are not familiar with it, but almost everybody probably believes, as I do, that clearing of credit derivatives is a great idea. But there are some issues about how it's going, the implementation, and I want to go through that based on some work that I've done with Haoxiang Zhu, who's a PhD student at Stanford. And I also want to thank Zhipeng Zhang, who's my research assistant at Stanford, for helping me get ready. So with all of that, let's see if I can make this slide projector work. Again, don't hesitate to jump in. I see a lot of familiar faces, so I'm sure that they know me well enough to interrupt me. In terms of transparency, thanks to the efforts of the New York Fed several years ago, we actually now can keep track, more or less, of who's exposed to whom on what credit derivatives. Now, when I say we, I mean anybody that gets access to the DTCC's DerivServ Trade Information Warehouse, which now collects the majority of CDS on sovereign and corporate names. And just to give you an idea of the kind of information you can get publicly, every week they publish how much credit derivatives have been written against credit events on each of a list of 1,000 corporate and sovereign borrowers. So just to give you an idea, we can see that by far the largest amount of credit protection being written against financial dealers is against the Bank of America. And part of that is that they now own Countrywide and Merrill Lynch. So these figures include Countrywide and Merrill Lynch, even though if you go to the DTCC warehouse and look, you'll see Merrill Lynch separated out. Legally, it's included. I've included it here. Countrywide was just included in the Bank of America figures recently as well. So that's a large amount. That's on the order of 240 billion. Of course, that's gross. If you go to net, it's more like 13, 14, 15 billion. And what's the difference between gross and net? Well, it's because a lot of people have offsetting exposures. Who are they? Well, obviously, it's the dealers, because they buy and they sell, and they end up net, not so exposed. I recently learned from reading some research by Alex Yavorsky of Moody's that there's actually another number that's also quite interesting, which is what's the maximum potential fail in the event that one of these names defaults and none of the protection sellers perform, and the recovery is zero. That's actually a different number than net exposure, which was an interesting thing to me. For example, in the Lehman default, there were 6 billion in net exposure, but Alex calculated about 21 billion potential fails in an absolute worst case scenario. Now, we also know that in the Lehman settlement, the payment claims were all made. This market has been vilified in the press as being at the root center of the financial crisis, as having caused a lot of losses. Well, neither of those is true. The total amount of losses, of course, in the credit derivatives market is zero, because for every buyer there's a seller, but the losses are moved around a lot by this market. And as for it being the cause of the financial crisis, well, it's certainly true in the case of AIG that that was largely the result of AIG writing a lot more protection than they should have, and the failure of AIG would have been disastrous, and the taxpayer bailout was also essentially a disaster. So the AIG affair actually says maybe there is an issue with credit derivatives that we ought to look into. Now, none of the proposals with respect to improving the infrastructure in the market, transparency, clearing, and so on, would have done anything about the AIG credit derivatives because they're so bespoke, meaning so customized to the CDOs that AIG was offering protection on, that in no way would they have ever been standard enough to be cleared or recorded at the DTCC. So essentially, from now on, if you don't mind, even though this is an immense exception, I'm going to restrict all of my remarks about credit derivatives to those that are, in some sense, treatable by market infrastructure issues like clearing and transparency. So in other words, I'm not going to be talking about AIG-style problems. I'm going to be talking about clearing and price transparency issues that are more for standard credit derivatives on corporations and sovereigns. When we talk about insurance in a little while, I'll come back maybe to talk about AIG. Anybody want to interrupt yet? Okay. By the way, we have not only some quantity information now, thanks to the efforts of the New York Fed to get the dealers to collect that information electronically and quickly, we also have some price information. Why? Well, because, of course, we can see at any day what Bloomberg says. I see my friend Bjorn Flesseker here from Bloomberg. He could probably tell us from his feeds exactly what the CDS rates are on anybody at any time. I looked this morning and I saw that Citi, which is my favorite subject of interest these days, is in the 5-year it's about 540 or so basis points, and in the 1-year it's about, if that's really a traded maturity, it's about 780 basis points. That's an alarmingly high level, so when I read that the senior unsecured creditors of Citi are not going to have to worry because they're too big to fail, well, apparently the CDS market doesn't think so, and I don't think we're completely out of the woods on that one either. So as you can see, there is some price transparency, but I think there could be more. I think that's one of the reasons that so many have suggested that we want to have exchange trading. It really isn't so much the clearing. We can get that, and I'll explain why, without having exchange trading. It's because so many people want to see more price transparency. Why? Well, because the OTC market is by definition privately negotiated trades, and we don't get to see who's buying from whom at what price. In fact, even on an exchange trade, we don't get to see who's buying from whom, but we do get to see the prices and the quantities. So that would add more price information, and the dealers might prefer otherwise. And this is not, there's no moral problem with saying we're a dealer market, we built this market, we invested a lot of money in building a market for which we can make money on spreads, and if we were exchange traded, we couldn't make money on spreads, and we would lose the value of our investment. And if everybody was going to take the markets away from us as soon as we develop them, then we won't develop them. Innovation would be dampened, and so on. So dealers have a stake in keeping the market somewhat opaque because their spreads are wider and they can recover their costs from making markets. And if you were to make the markets too transparent in the OTC world, then there wouldn't be enough spread in some cases for the dealers to justify their costs. The liquidity might go down. So there's some perhaps middle ground to providing more price transparency. In the corporate bond market, we have a system called TRACE, also in the municipal bond market, where essentially every single over-the-counter trade is available to the public with some delay, not too much, and within a quantity range. So a customer can ask his dealer or her dealer, how come at my execution I wasn't getting anything like the sorts of executions that were going on yesterday? And I think that's a good thing to bring to the credit derivatives market to some extent, although it's a judgment call for the reasons that I just mentioned earlier. So I don't have a clear black and white view on what to do about price transparency. I do have a pretty strong view that the exchanges couldn't possibly support trading in 1,000 different names. There's not enough liquidity to do that. That's why we have an OTC market in many respects. So you know, the issue of price transparency in exchange trading is slightly a red herring. We could have price transparency without exchange trading. We can get the effect of clearing without exchange trading. But in some cases, exchange trading would probably result in a more efficient allocation of CDS and other OTC derivatives. But we have an economics issue here about how that migration will happen. And I don't think that Congress or regulators should dictate particular credit derivatives moving from the OTC market into the exchange market. But I think it wouldn't hurt to see some of that happening either from the goodwill of the dealers or by some other market mechanism. But I haven't figured out what mechanism might cause that migration to happen. So if some of you have some views on that, I would like to learn about them. Okay, so that covers a lot of what I wanted to say about the issues of transparency and about exchange trading. I want to mention one thing. Had it not been for the DTCC's DerivServ information warehouse, I would have been very concerned at the default of Lehman about the integrity of the OTC credit derivatives market. So when I say that no, the CDS market was not at the root cause of the financial crisis, had that improvement in infrastructure not occurred, I might have felt much differently. So I think these infrastructure improvements that we're talking about are very important, and we should continue to focus on them. And the one that I'm going to focus most of my attention on for the remainder of this is the issue of clearing. Any questions before I jump into that? Yes, sir.
At least out of the press, you do have people criticizing the market for lacking risk transparency. In other words, they're not so much talking about the prices either before or after the trade, but they're talking about who has the risk. Although I quite honestly don't know of any market, even on the exchanges, where you could find that kind of transparency, and it's usually done by talking heads. But do you have any thoughts on that as far as the transparency positions?
Yeah, I think, in fact, I've even read from near experts that if we had only had clearing or exchange trading, we would know who's written protection on whom, and therefore who to worry about. Well, that's absolutely not true. Clearing has nothing to do with revealing information about who's trading with whom. Clearing doesn't even give you price information. Who should get that information? Well, obviously, or at least in my view, it's obvious that regulators should have a lot more information even than they have today, or at least more systematic information than they have today, on who has written protection on whom for how much. And I've made my own suggestions to regulators about that. I don't think the public should know that because it dampens incentives to trade and to collect fundamental information about the fundamental risks underlying corporations and sovereigns if you are forced to tell the world as you're accumulating your position. We do have something analogous in the equities market when you are going to achieve a control position in an equity to reveal to the world that you have more than 5, 10, or 15% of an equity. That's the only situation. And it's not really that analogous here because the CDS does not give anything in the way of control. So I don't think there's any control-related reasons for transparency. There is one reason, in fact, Björn and I were discussing it just before we got started tonight, and that's a situation in which there may be a moral hazard of a creditor to a corporation who has bought protection and has not revealed that he or she has bought protection. So I'll give you two examples. You have a firm that's gone into restructuring, and there on the creditor committee sits a large, let's say, senior unsecured bond investor who's ostensibly representing the creditors of that firm in getting that company resolved to the favor of the creditors. And at the same time, that bondholder may have bought protection to the extent that he or she is even more in the direction of hoping that the recovery is very low. And that is not a good situation, and I think something ought to be done about that. Another situation is one in which I am a bank that has lent a lot of money to someone, and then I turn to someone to lay off the protection as a buyer of protection, and I don't tell that individual that at this point I really don't have a good reason to service and monitor this loan very carefully or to make sure that the indentures are well observed, and so you're on your own. That information is not available. And there it's a much harder decision because banks use CDS a lot to buy protection. And I really don't know what to do about that one, but it does give me some pause for concern. So those are the only cases I know of where there might be a public interest in knowing who is exposed to whom in the credit derivatives market. But from the viewpoint of fundamental research and trading interests, I think that information should not be revealed publicly, but it should be revealed to regulators. That was a long answer, sorry. David, if you want to follow up on that.
Well, you brought up an interesting point about the bankruptcy issue. I mean, do you think, there's been a lot of noise made about that affecting the incentives of parties to bankruptcy, but the problem I have with that argument is how would you ever be able to build up a position unless you just happen to have been so prescient as to buy protection back when it was cheap on a party that later went bankrupt? I just have a hard time understanding how you could systematically exploit that in a way that would distort the system. Although, I mean, it sounds like the remedies, which is disclosure, don't sound that draconian.
No, I would say if you're on a creditor committee, that's an officially designated committee. We already have a system called big boy letters by which the creditor committee discloses to counterparties in the corporate bond market the position of that individual as an insider. I think it's a very analogous situation that if you're sitting on an official creditor committee, you should be required to disclose your opposite direction, same direction I don't have a problem with, but opposite direction exposure in the CDS market. Okay, so just to remind everybody, the OTC market is a bilaterally negotiated market as opposed to an exchange-traded market, which is centrally negotiated. And what we're really dealing with in the OTC derivatives market for credit derivatives is really a dealer-based market. So those giant volumes that you've been reading about, 60 trillion last year, now it's down to about 30 trillion. We'll talk about why in a minute. That's really dealer-to-dealer exposure from the fact that the dealers are doing intermediation and from something that's called novations, which is a way really for counterparties, rather than to cancel or buy their way out of a position with the original dealer, to take an offsetting position with another dealer, but the original credit derivative gets novated to yet another dealer, and that can cause a huge buildup of positions in the interdealer market. So as we head into a discussion about clearing here, most of the issues with respect to clearing are dealer-to-dealer issues. Not entirely. There are large hedge funds who would also want to be able to clear and have access to the clearing systems. But in terms of the systemic risk, the vast majority of it is dealer-to-dealer exposure, and that we're trying to get that down. Why? Well, because if a large dealer fails, obviously that's a systemic problem in itself, and it may cause another large dealer to fail. So we have a public interest in seeing that these inner exposures, the inner hub of this market, the exposures are relatively low. Yes, sir?
Was AIG considered a dealer, or they were simply just writing protection?
Yeah, so dealer, no. AIG would not have been considered a dealer. And again, it's sort of operating under my exclusionary carve-out of the AIG derivatives as something that would never have been treatable by clearing because they were bespoke, one at a time, things that nobody else would have ever wanted to clear, and would not fall under any of the definitions. For example, Tim Geithner's definition of a standard CDS that should be cleared. Okay, so now I'm going to talk about what is clearing, because I'll bet 90% of you know more or less what it is, 95 or 99% know vaguely what it is, and only a few people know really, really precisely what it is. So let's just go through it, and I'll do the vague version, and then you can ask me about more details. I'm sure that we have somebody in the audience that can give you right down to the last boilerplate fine print on the back of the contracts. Okay, so we have two dealers in this example, and they have written a CDS, and at this point, maybe it's on GE Capital, at this point, dealer A, on a mark-to-market basis, owes $100 million on that CDS to dealer B. That is, if you were to cancel this, if you were to mark this position to market, and dealer A were to pay off dealer B to allow them to get out of the trade, it would be a $100 million mark-to-market payment. In other words, dealer B is concerned that dealer A may default. And we'll talk about collateralizing this trade. Typically, dealer B would demand collateral. The average amount of collateral, in frequency, it's about 65% of this market. This is to figures. 65% as of the latest available are somewhat collateralized, but we don't know. And we also know, basically, in total market value terms, how much the collateral is. We don't have all of the detailed information on the degree to which dealer-to-dealer positions are collateralized. but say order of magnitude, 2/3 of these are collateralized. Collateral is a very scarce thing, and I'm going to focus a lot on collateral as we go through this. So along comes a central clearing counterparty, which many of you would think of as a clearing house. And we'll talk about the names involved. And this clearinghouse will stand in between the two dealers. Instead of A buying protection from B, now A is buying protection from a central clearing counterparty, a special kind of financial institution. And the central clearing counterparty is buying protection from dealer B. So now neither of the two dealers need to worry about performance on this trade. But of course, they both have to worry about the central clearing counter's performance. And provided that that central clearing counterparty, which essentially is guaranteeing the performance on this trade to both counterparties, provided it's well capitalized and has good operational controls, we don't need to worry any longer about performance on this credit derivative. And that, just if you stop right there, is a fantastic innovation in this market. Why? I'll give you a couple of examples. Go back to Bear Stearns failure. What we had going into Bear Stearns were a lot of counterparties to Bear Stearns were saying, uh-oh, I don't want to be involved with Bear Stearns if and when they default, so I'm going to novate my position to another dealer. And there was a flight from Bear Stearns of credit derivatives and other OTC derivatives positions to other dealers that actually caused two problems. One, it exposed the other dealers to Bear Stearns, increasing systemic risk. And two, it exacerbated Bear Stearns' cash problem because every time they novated the trade, their cash collateral was released, causing a bleeding of cash from Bear Stearns, in addition to other things like rumors. If everybody knew that no problem because that trade I made with Bear Stearns, it's been cleared, all I have to do is sit here and hope that Bear Stearns doesn't default for its own sake, but I don't have to worry myself, that's great. That's one example. Another example is, let's take the problem that we see in the corporate bond market now. Corporate bonds are trading, at least they had been recently, at very large negative basis, meaning they're trading very cheap relative to what they would be if you looked at the CDS market. That's a broken trade. The corporate bond market is very illiquid. Dealers have not had enough shelf space in their balance sheets to hold a lot of inventory in that market, and the market has suffered as a result, and prices are low. And that's one of the reasons the banks are low on capital. And actually, it's a self-fulfilling thing. If it was possible to bundle the corporate bond with a cleared credit derivative, making it very close to a risk-free bond, so you don't have to worry about counterparty risk, then you could take that bond and you could give it to the Fed as collateral on a loan. That the Fed would only have to make a modest adjustment in its collateral standards to accept a cleared, meaning essentially risk-free bond, because if the bond doesn't perform, then the central clearing counterparty would. And that would, first of all, get rid of most of the negative basis. And secondly, it would improve the liquidity in the corporate bond market. And thirdly, it would improve the positions of the dealers in the corporate bond market for making markets. That's two examples of why having central clearing is a great idea. Again, this is all under the proviso that the central clearing counterparty is very well capitalized and isn't going to fail except in a million-year flood, hopefully. Now, we've heard these sort of stories about central clearing counterparties never failing, but we have to worry. There have been several that have failed in the past. I gave an example. I gave 3 of them as examples in the paper that I distributed. Now, 2 of them are very obscure. 1 of them is somewhat obscure, but they can fail. So, central clearing, good idea. Make sure the counterparty quality, making sure the central clearing counterparty is good quality, lots of benefits, and I'm all in favor of it. Now let's talk about an even bigger benefit, which is the benefit of multilateral netting. Now let's go to a situation where BO's A100, AO's say 80, and CO's B90, all on the same market, say credit derivatives. Okay, so in this situation, without any central clearing, the maximum loss to anybody is 100. The minimum loss is 80. If one of those dealers failed, you could lose between 80 and 100. Along comes the central clearing counterparty. Boom. Look at A's position. A was getting 100 and was paying 80 on a mark-to-market basis. So now A is owed 20 on a mark-to-market basis from the central clearing counterparty once those CDS are cleared. B, instead of worrying about getting paid 90 by C, and having to pay 100 to A, B merely has to owe the central clearing counterparty 10 on a mark-to-market basis. And likewise, C owes 10. So even better than what I just described, or at least as a separate benefit. This benefit was standing in between the two dealers. The exposure is the same. It's 100. We just have a better counterparty in some cases. In this case, the exposure has gone way down. This is multilateral netting. This is a much different kind of benefit of clearing than many people have been thinking in terms of. Most people have been thinking in terms of this situation, a safe go-between, as opposed to this situation, a big reduction in exposures. There's a question way in the back.
Yeah. So would not the central clearing party then know the exposures of A, B, and C, which goes to the earlier question, information from regulators and then being able to report them?
Yeah, so the central clearing counterparty would, by virtue of doing this, know all of these positions. So it would have a lot of private information, not as much even though as the DTCC has today. And in fact, all of the clearing that we've seen will probably at best get up to the level of information that's currently available to regulators at the DTCC if they should choose to get it there. So when I mentioned trace, you wouldn't really have to set up a trace system. If you really wanted that kind of price transparency, you could simply mandate that the DTCC provide price information directly through a reporting system. Or if the regulators wanted price information, they could get it directly now from the DerivServ Trade Information Warehouse at the DTCC. Okay, now, central clearing, great idea. In fact, as Mae West once said, too much of a great thing, it's wonderful. Well, maybe not in this case. We've got a situation now where we have a proliferation of central clearing counterparties. In the United States, 2 have recently been approved, the ICE and the CME, working with Citadel. I'll come back to them in a second. And in Europe, there are now 5, and there are more being proposed both for the US and for Europe. In Europe, some of the central clearing counterparties that have been proposed are really due to a protectionist measure in Europe to make sure that if there's going to be a new important business activity, that it shouldn't just happen in London or New York, it should also happen on the continent of Europe. And dealers who deal in Europe have been threatened with significant increases in regulatory capital requirements if they don't clear their Eurozone credit derivatives in Europe, which means new European central clearing counterparties will automatically need to happen. And the dealers have signed up to do that by July. Now, I hope that cooler heads will prevail and this will all get rationalized. But in the meantime, we have a proliferation of central clearing counterparties, and there really isn't any need for this. In fact, I'll explain in a moment why it's quite damaging. One of the reasons that we don't need it is that all of the same people are basically doing the lion's share of all of these trades. So anybody that was doing their clearing in New York, I mean, it could be done globally in New York, or it could be done globally in London, or at worst, it could be done in London and New York. But it should be done as much as possible in the fewest number of places, and it's kind of easy to describe why. I mean, here's the situation we had before. A, B, and C, exactly the same numbers, but now we're going to have 2 central clearing counterparties. One of them will handle the trades between A and B, and the other one will handle the trades between A and C and B and C. Well, clearly, it looks ugly. It is ugly. And the exposures are much, much higher to the counterparties than they need to be. Not only are the exposures higher, as you can see, now the maximum loss is 100, 100, 90, and 80. We've got even more large exposures now than we had before. But all of these 3 dealers are now, or at least A and B, are now paying guarantee deposits, which are large amounts of money designed to guarantee that they will perform to the clearinghouse. They're paying large guarantee deposits to 2 clearinghouses. Now, if there's 7 of them, they'll pay them to 7 clearinghouses. There's, you know, not all of them will survive, but a lot of them will collect guarantee funds, and then a lot of them will be new systemic financial institutions that all need to be regulated very carefully. So every one of these red triangles is another place where central bank and other regulators are going to have to go in and make sure that they have enough capital requirements. Because if there ever is a systemic counterparty, it's of course a central clearing counterparty. Now, you could say, well, central clearing counterparties 1 and 2 could get together and work out a way to reduce the exposure. It's actually, I mean, I've looked at this. It's not as simple as you might think if you have to do it in real time or in short order. Plus, they're all going for different standards on collateral requirements. And getting them together on that will be a competitive problem. So right now, none of the proposals include somehow dealing with the proliferation of central clearing counterparties. In fact, there are almost as many central clearing counterparties on discussion now as there are dealers covering 90% of the market. Yes, sir?
Could CCP2 in your thing become a special clearing member of CCP1?
Could.
And that way you get a virtual single clearinghouse, but you have several that could compete on their service or whatever.
Yep, that could be done. There's no reason that you couldn't have one central clearing counterparty clearing for another. And maybe it will come to that. Now, it would be a very interesting business situation to have one of these that's competing for market share concede that it really is going to be not a hub but a spoke for a different central clearing counterparty. There might be a way to do it. Another issue here is that as these central clearing counterparties are competing for business, now how would I compete with you? The only things that I can compete with you on are fees, so I could charge a lower fee, or collateral requirements. I could set lower collateral requirements, or guarantee funds. I could demand a lower guarantee fund. Now, of those, the fee problem is not such a big deal, but if I start competing by requiring less collateral, then there could be a race to the bottom. So we don't want, this is a classic high fixed cost, low marginal cost business. It's a setup for a situation in which you're going to get a race to the bottom on standards if you allow complete freedom. And of course, the regulators won't allow that. They'll try to make sure that that doesn't happen. Okay, now we're going to go to a different problem with the manner in which this market is getting cleared, a completely separate problem. Now we're going to say, okay, A owes B 100 on CDS, but B owes A 200 on an interest rate swap. Now, under the current bilateral netting standards that are used in the OTC derivatives markets and the master swap agreements, you'll see that all the collateral is based, and all of the settlements at default of either counterparty are based on the net of the two. So 200 minus 100 equals 100. The net exposure here is 100. Along comes our central clearing counterparty for CDS. Uh-oh, the bilateral exposure just went up to 200. And now we have additional bilateral exposures to the CDS, a central clearing counterparty. So we've got a large increase in exposures. Okay? So the issue here is when we clear credit derivatives, we're losing the opportunity to do bilateral netting against other types of OTC derivatives, but we're gaining the opportunity to do multilateral netting. Okay, so it's one force against another. Which force is going to win? This is where Haoxiang Zhu, my co-author, and I came in, sat in my office one day and said, you know what? This is not obvious that it's always going to be one way or always going to be the other, that multilateral is always better or bilateral is always better. In some cases, if you have enough multilateral netting going on, counterparty exposures are going to be reduced through multilateral netting more than you're going to lose through the loss of bilateral netting. And so we actually did the calculations. If I have a minute, I'll show you at the end some general proposition for an example, a mathematical model of an OTC derivatives market. But basically the answer is the following. In the current the real world credit derivatives market numbers, there is nothing like enough credit derivatives to get the benefit of multilateral netting that you see on this picture dominate the loss of bilateral netting that you see in this picture. So you run the numbers, it's not even close. There will be an increase in counterparty exposure as we go into dedicated CDS-only central clearing. The way to do this, of course, is to centrally clear both the interest rate swaps and the credit derivatives. It's not technically challenging. The same credit clearinghouse in London called LCH Clearnet is already doing almost half of the world's interest rate swap clearing. That is, almost half of the volume of interest rate swaps, of standardized ones, are now being cleared through LCH Clearnet. And it's also setting up to do CDS clearing. There's no reason it couldn't do it in the same clearinghouse. It's not, and I'm not sure exactly why. Maybe somebody here can explain that. But none of the US-based central clearing counterparties are currently being set up, as far as I know, to do both interest rate swaps and CDS, never mind all of the other credit derivatives. I see there's a hand that's gone up in the back of the room. Yeah, okay, so the CME is technically able to do both, although, as the woman in the back of the room has suggested, it's not really taking off. If you want a scorecard, as of yesterday, about 99 or 97 billion have been cleared through the ICE and 0 through the CME. And Leo Melamed says that one of the reasons is that they were originally forcing the dealers to do their clearing through the internal CMDX sort of trade clearing mechanism of the futures exchange, and now they understand that the actual trade processing needs to happen in the bilateral market for the dealers to be happy there. So maybe the CME will recover, and maybe the CME will get the benefit of multilateral netting beyond the credit derivatives. I'll go into some distinction there. They're not actually doing much in the way of interest rate swap clearing either, so it would really be the benefit of netting at CDS, at the Chicago Mercantile Exchange, with futures that are already being done there, as opposed with interest rate swaps. Gentleman here?
You made an observation a minute ago saying that if we move the CDS to a central counterparty, we would lose the benefit of bilateral netting. Is that because of the concentration in the dealer market for CDS?
Okay, so that's basically the issue. There aren't enough dealers to get enough to make multilateral. The multi-part needs to be n larger than that. You need n is about 40 or 50. And right now, n is between, say, 10 and 15, if you think about it as number of symmetric dealers. So it's way below.
Also mean that if we allow some of the buy side, like hedge funds or people like primers, to participate in the clearinghouse, then we would get the benefit of multilateral netting.
That's an interesting calculation. It increases the multilateral netting, but the question is whether the dealers, if you think of the dealers as being the ones who are the systemic counterparties, and being in the middle of many, many different kinds of derivatives to each other and to the outside world, whether their positions will be better. And I don't think simply adding additional hedge funds to the clearing will help the dealer exposures at all, but it might help the hedge funds some. But that's a calculation that I haven't done. Right here, sir.
Curious whether the calculations were done in consideration of multiple entities within the different dealers and the different things that would be
Okay.
between those sub-entities.
Yeah, okay.
Or is
So,
it just Goldman is one, JP is one?
okay. So the gentleman in the front row is asking, I don't know if I'm repeating all the questions enough, but the gentleman is asking, what about the fact that if I look at JP Morgan versus Goldman Sachs, that it really isn't just two firms, they have many different possible master swap agreements under which netting is occurring. And no, the calculations weren't done based on that with the numbers that I gave you. So if you take advantage of multiple master swap agreements among each dealer, then N gets to be bigger and it gets closer to making netting a good thing. And by the way, central clearing a good thing. And I'm all in favor of making it a good thing because, as you know, I think central clearing is a great idea. Now, having said that, I think if you look at the concentration of exposures on the Goldman to JP Morgan master swap agreements, the lion's share of them will be on very few master swap agreements, if even more than one, because it's currently in their incentive to keep it down to the smallest possible number. Now, it may be true that Goldman Hong Kong and JP Morgan Malaysia are not under the same master swap agreement as the two large parent firms might be. But the vast amounts of it are kept, the master swap agreements are keeping that down to a very small number of highly concentrated master swap agreements. Okay, just to give you an idea, you've all heard these outlandish stories about how big the CDS market is. In terms of actual exposure, it's about 3 trillion. The interest rate swap, these are the latest available BIS numbers. The interest rate swap market is about 9 trillion. about 3 times as big. So if you're talking about taking advantage of multilateral netting, you really want to do the CDS together with the interest rate swap market. Bill Winters. It's a public document. I'm not describing anything that's private information. I just exerted page 14 and 15. JP Morgan has about 88 trillion, actually, in its last report of a couple weeks ago, 87 trillion in notional. Of that, about 2.7 trillion gross receivables. That's how much it would lose if all of its counterparties failed to pay on the entire marks to market. That's before considering bilateral netting, which is 2.4 trillion. So we're down to 266 billion after netting, a pretty small slice of $88 trillion. And of course, there's a lot of credit risk mitigation on that tiny slice. And the next slide shows you how, and I'm not going to go through this slide in detail, but how they deal with that with collateral, which gets it down a lot more, and then basically by diversification. So going back to the original picture, bilateral netting is a very powerful tool. And you already are getting a huge benefit of effective clearing through bilateral netting in the ISDA-based master swap agreements. Just to give you an idea, let's go back to this picture. This picture, this is A and B. Now I'll make A and B a hedge fund. Who stands between the hedge funds? Well, JP Morgan. They have 5 trillion CDS on one side and about 5 trillion on the other side. And if you look at their total CDS, they are currently very close to 100 times the Intercontinental Exchange clearing. And they are doing literally, under the same novation, master swap agreement, OTC standard agreements, they're doing literally 100 times the amount of clearing through bilateral arrangements as the ICE is doing through multilateral so far. So before we get too carried away with saying, thank gosh, we are way better off now that we have central clearing, let's remember that the vast majority of exposures in this market and effective clearing going on in this market is already happening in the major dealers. And we want to be really cautious when we fiddle with that formula. And I think we should fiddle it and go to central clearing, but I think we need to do it in a much more careful way. And just to summarize, very few, if more than one, central clearing counterparties for CDS, and try to get not CDS dedicated central clearing counterparties, but to get the other big OTC exposures to go in at the same time when you do it. So as more and more CDS comes off to central clearing counterparties, exposures are going to go up, collateral requirements are going to go up. That's going to be very expensive for the dealers. And if we want to get them back down again, we want to do what I suggested. Fewer central clearing counterparties, more types of derivatives, particularly interest rate swaps, but also equity derivatives present a significant amount of exposure. Yes, David?
I just want to make sure I understand, but would you favor having non-dealer counterparties having access to the clearinghouse as well, or would they go through the dealers as they are doing it?
I noticed that the Fed convened a meeting recently of the major dealers, and it has essentially all the major dealers in credit derivatives to talk about clearing. And I also noted that they also invited 5 or 6 or 7 large non-dealer, mostly hedge funds. And I have a feeling that the Fed is going to jawbone the dealers into including some large hedge funds. And I think it's a good idea. But I think it's a good idea because it will further, for only the largest ones, it will further improve the integrity of the OTC derivatives markets. But I don't think it cuts either way on the issues that I presented today. That is, I think everything that I said today applies equally well whether or not you include some large hedge funds in the calculations. Yes, sir. By the way, I'm finished my formal remarks, so I have some additional slides and materials that go into the calculations, but I think I've yammered on enough, so I'm just going to take questions if that's okay with everybody.
On a related issue, I mean, a futures clearinghouse, not everyone faces directly to the clearinghouse. They have clearing member firms. The exchange sets capital requirements firms may charge or may ask for more collateral than they are required to post.
Exactly.
And so how do you see this industrial organization translating to this CDS?
It's exactly the same. If I was a hedge fund and I wasn't included in a central clearing counterparty arrangement, but I had a prime brokerage account with JP Morgan, then I would be required to post collateral to JP Morgan. JP Morgan would be required to post collateral to the central clearing counterparty. That's exactly the way it happens at futures exchanges. And in fact, the CME proposal is basically jamming the central clearing counterparty onto the back end of its current clearing operations. So there's really not, and conceptually, and in terms of economics, not much of a distinction. The legal aspects are quite different, of course.
But what you mentioned, for example, the Fed bringing some hedge funds and some buy side.
That's the speculation on my side, on my part.
But I know people are talking about that. I mean, it's not a bad speculation. The question is then, do these same kinds of rules get applied to, say, a hedge fund? I mean, does a hedge fund become a clearing member?
Of the exchange?
Yeah, no, of the...
Well, I think some of them are, well, my guess is some of them will become, and many of them won't be. I mean, there's thousands of hedge funds, and I'll bet you only the top 5, 10, or 20 end up getting, well, first of all, they have to post a huge guarantee fund, guarantee contribution of capital into the central clearing counterparty as a performance, and that's very expensive. Secondly, the volumes, they'll probably be, the fee structure will probably incent you to do it only if you have huge volumes. So my guess is it'll be the dealers, and not all of them even, maybe 10 or 20 dealers, 15 is most likely, and maybe 5 or 10 hedge funds or other institutional investors. Maybe a PIMCO, something like that, who knows. Okay, so I'm going to start taking questions. I'll take the gentleman to the left of my vision right here in the white shirt. Yeah.
You mentioned originally that what you stated relies on the CCP being well capitalized. And my question is, at the outset when the CCP is formed and its trading begins, if a couple of significant counterparties were to go under, is there enough in that fund to cover some of that?
That's a great question, and it's very similar to this question about how futures markets work. Here's how it would go. So I don't want to use any names because we don't want to have any talk about hedge funds failing, but suppose hedge fund X failed, or dealer X failed, and the central clearing counterparty would do the following things. First, it would shut down the ability of that X firm, the dealer, say X, to do any additional trading. Then it would mark to market the positions. Then it would buy out those positions. It would take the collateral that's available from that counterparty to do that. If that wasn't enough, it would start dipping into the guarantee fund. And if that wasn't enough, it has its own discretionary fund for this purpose. Not discretionary, but designed for this purpose. And if that's not enough, it's good to the last drop through all of the dealers that are clearing. Now, I put in good to the last drop. We have to be a little bit careful because if I was a dealer, I don't know if they're actually doing it, I wouldn't put, if I was JP Morgan, I wouldn't put the entire JP Morgan franchise into this arrangement. I would put a particular kind of derivatives, OTC derivatives subsidiary as to some extent legally remote from the balance sheet of JP Morgan to do this, but I don't know if they can actually carry that off. But in any case, there's a lot backing the failure of any one of these dealers, and provided that everybody observes the rules and the IOSCO, which is the standard setter, infrastructure rules are, operational controls are there, and the Fed is blessing the guarantee funds and so on, I think that this is likely to be done very well, at least in the US. And I think there's no reason to worry about it in Europe, but the more there are, the more you got to check. And that's a lot of regulatory attention, and anything can happen. There's a gentleman right here.
What would be the motivation aside from business decisions being a clearing business for a large hedge fund to want to be a member of the clearing house?
Okay, well, the fees are the biggest thing. And this is expected to be a $100 million kind of fee revenue business. And it's probably also lots of synergies with other clearing and exchange related matters. So, there's a tie-up now between DTCC and LCH ClearNet that's on the books. For those of you that are following Just today, it was announced that Credit Suisse and Nomura are joining a bid with JP Morgan, UBS, Deutsche Bank, and a couple of other very large dealers to take over LCH ClearNet. Part of that is probably the fees in the business, but part of it is probably their ability to control their environment. And I think that's why the dealers have been so strongly interested. Right now they're doing the ICE. They're taking half of the fees in the ICE business and contributing to that business, partly because of the fees, partly because it allows them to control their business environment. They were against doing their clearing at the CME. One can speculate that the more that's done at the CME, the easier it is for the OTC business to migrate to the CME as a futures business, the less profitable the OTC business would be for the dealers. And that's a matter that I discussed earlier. So for a number of reasons, the dealers are interested in backing this clearing business. And they had been told for some years by the Fed that they better get behind clearing because the Fed is very displeased with the kind of Wild West nature of the growth of this market. First on documentation, which it got under control, and now on clearing. Björn.
Any perspective on clearing CDS where restructuring is accredited on? Because the new North American contract change is
Yeah.
Will it seems to bring it into conflict with other banking regulators suddenly? So
Yeah. Okay, that's a very interesting thing. So let me take you back to remarks I made a few minutes ago. The question is, what about restructuring and its role in the clearing? And I'm just going to back up a little bit. Historically, when we started to see clearing coming, and Treasury Secretary Geithner said all sufficiently standard CDS shall be cleared, well, obviously, if it's going to be done, you have to have standardization. And one way to standardize is to make the different types of credit events become very simple. And the easiest way to do that is just to rule out restructuring. It also mitigates the potential problems at settlement. If it's an outright default rather than a restructuring, meaning a bankruptcy or failure to pay on the one hand versus a restructuring on the other, if it's an outright default, it's much easier to treat it as a standard product. On the other hand, there's always another hand, in Europe, there's a lot more bank lending, and banks would be very interested in having restructuring covered. And my suspicion, based on conversations in part today, is that in Europe, the banks will be pushing against this new big bang standard to rule out restructuring as a covered event for standard CDS, or at least maybe they won't be able to clear if they do follow that procedure of keeping restructuring in. Why is ruling restructuring out a bad idea? I'll do the pros and cons. A good idea because it makes clearing easier. It's a bad idea because A, banks won't be able to control their risk as well, which means their regulatory capital requirements will get higher. And B, there will be some moral hazard. I'm a bank. I've lent you a lot of money. And what I'd really like to do is restructure you because that's going to be the most efficient way to get you rationalize your business. But I bought CDS that doesn't include restructuring, so I'm going to pull the plug on your business and make you default so that I get coverage. That's not a good situation either. So far, I haven't heard any concerns of that type aired, so maybe I'm just, maybe it's really not a big concern. But those are the two things you might worry about. Steve?
The way mark-to-market margining works for all the traded futures and every other kind of instrument, derivatives that we've got, we're looking at something, the market value fluctuates somewhat from day to day, and each counterparty is supposed to put up a multiple of the normal daily amount. So it's very hard to end up defaulting on something where you haven't got pretty much coverage of everything. The one instrument where that's not going to work is a credit default swap, where if there's a credit event, you are potentially on the hook for a whole lot more than any mark-to-market margining system would have had you put up in capital.
Mm-hmm.
Earlier you said you were going to talk about credit default swaps as a potential insurance product. I'd like for you to do that.
Okay. So, by the way, on this issue of collateral, essentially, there's not much difference between OTC versus non-OTC with respect to collateral, with some exceptions. And those are interesting ones, like AAA firms in the past were not required to post very much, if any, collateral. Warren Buffett, AIG, Fannie Mae, Freddie Mac, guess what happened to 3 of those institutions? So collateral is very important. It's just when you need the collateral that you're getting into these situations where you should have had it. regulation of, the question is mainly, what about the regulation of credit derivatives as insurance contracts? Now, the sort of superficial answer to it is, as I've always taught it to my MBAs at Stanford, a credit derivative is nothing more than insurance against the default of somebody. So why not regulate it as insurance? The problem is the way that the insurance market is currently regulated, it's a patchwork of state-based regulations. There is no opt-in to a federal charter right now. So if you go to the Brookings Institute website and read a paper by Robert Littan, L-I-T-A-N, you'll see a very nice essay on what's going on in the insurance regulation area that would be relevant for financial markets. And based on what I've learned from Robert in discussions, I just don't think the insurance market is ready at this point to have credit derivatives treated as insurance. Why? Well, a dealer would have to be regulated under many different states. There, as far as I understand it, there would be no carve-outs for a firm like JP Morgan that's $5 trillion long, or 5.3 trillion long and 5 trillion short. It would end up having immense insurance regulatory capital requirements. There would have to be some exceptions made. The dealer community would have to be treated specially. We're just not ready for it. That's my main objection to treating it as insurance. Now, I just want to follow up by saying that there are many commentators that are so against the credit derivatives market, a lot, like George Soros, that would essentially say, too bad, this market is out of control, and if enforcing it as regulating it as insurance causes it to almost disappear, where it's only being used in a sort of traditional insurance context, that's all to the good. That's what some commentators might say. I actually don't believe that. I think the market is a very important financial innovation, and having a lot of volume and liquidity is good, provided we get some improvements in infrastructure. So my general answer is it's not ready for it. David?
If we go even further, I think the problem is not just that you have 50 different jurisdictions.